really the only short-term solution. And when we're talking about the short term, we're talking about into like June and July, right? Because that's where most of the uncertainty is on whether or not these Florida domestic primary insurers are going to be able to get the capacity for their reinsurance programs, or they'll be able to get it at a price that makes economic sense for their business models, right? So down low in their reinsurance programs is where that capacity is more restrictive right now, where the reinsurers and the retro session reinsurers are kind of pulling back capacity. The market has tightened. So the only thing that really the state can do is provide some state reinsurance capacity. Now, we have an entity already. It's the Florida Hurricane Catastrophe Fund, and it provides reinsurance to the private primary market. They provide $17 billion worth of coverage, but that coverage doesn't kick in until they have what's called an aggregate retention, which is if you take every participating insurance company that participates in that program, kind of their deductible would equate to about $8.5 billion. Now, that's every company has their own attachment point, but if you look at it in the aggregate, that's where it's at, 8.5. That number or that deductible has been increasing every single year. The problem is it's increasing to such a high point that the relevance of the CAT fund is becoming less and less as it continues to move up. It's just kind of like, think about it if you have homeowners insurance and you have a deductible. If every year your insurance company keeps increasing the deductible on you, so there's less and less chance that you can ever get a payment from your insurance company, you're going to start to think to yourself, why am I paying for this insurance if they're making it more difficult for me to actually access my insurance policy? That's what's happening with the Florida Hurricane Cat Fund. And that's why now, since that aggregate retention, or for layman's term, deductible, has increased so high that below that point, the reinsurance capacity in the private market has either gotten very expensive or difficult to get. So, short term, really the legislature, they have to provide some type of framework to provide reinsurance capacity below the CAT fund at a rate on line that makes it economically feasible for these insurance companies to continue to do business without having the threat of going insolvent. That's the only thing you can kind of do in the short term. So you can do that by lowering the aggregate retention of the CAT fund. So you could lower that deductible from $8.5 billion down to $4.5 billion, adding an additional $4 billion in capacity. Or you could provide an optional layer underneath the CAT fund of $4 billion worth of capacity. Or you could provide, a reinsurance layer of a certain amount to certain companies that meet certain criteria, right? So sometimes they refer to it as a limited apportionment company layer, which means a certain amount of companies based upon their policyholder surplus of X amount of number would qualify for this coverage. And then they could purchase a certain amount of reinsurance capacity based upon a certain percentage above their policyholder surplus. So I know that sounds really kind of complicated, but at the end of the day, what you want to do is you want to provide some type of short-term reinsurance capacity from the state to the market to get through this June 1st, July 1st reinsurance season. Now, if you want to talk about longer-term reforms, these are things like talking about, well, why is reinsurance so expensive anyways, right? Why is the insurance so expensive? Well, the cost is based upon the risk and what the expenses have been. And there's no doubt there is a number of bad actors in every single industry that are kind of gaming the system, a number of loopholes out there that people are utilizing to enrich themselves, right? And try to increase their own financial benefit at the cost of consumers, right? So everybody you talk to would agree that that's going on. what the legislature needs to do is they need to look at every single stakeholder group and say, listen, are these guys gaming the system? Are they committing fraud? What is the behavior? What are they actually doing that's kind of creating these market distortions? And then craft legislation to crack down on those behaviors. That's the best thing that they can do to send a signal to the risk capital markets and to the reinsurance markets that these subset of individuals that are gaming the system will no longer be tolerated in Florida, and we're going to crack down on it, right? So, some of it is, outright hard fraud where they're actually, manufacturing claims. Some of it is soft fraud where they are kind of like expanding the scope or expanding, the cost of these claims versus what, they really should be based upon, the current market value costs. But whatever the gaming is, you need to identify who's doing it, identifying exactly what they're doing, and then craft legislation to stop it. And that will send a signal to the marketplace that these type of behaviors won't be tolerated.